We're proud to have this episode sponsored by ShakePay, the easiest way for Canadians to buy and earn Bitcoin. I love using ShakePay because it's fast, it's easy, the app is great, and it doesn't hurt that they give away free sats, which is free Bitcoin, every day just for shaking your phone. They also have the ShakePay prepaid Visa card issued by People's Trust that earns you up to 2% cash back in Bitcoin. Not points you have to redeem, just Bitcoin added to your account automatically. Like I said, ShakePay really is the easiest way for Canadians to buy and earn Bitcoin. So join the over 1 million Canadians already on ShakePay. Sign up is fast and free. It's so easy, a boomer can do it. Plus, sign up for ShakePay with the promo code Loonie Hour, and you'll receive $10 after you buy your first $100 worth of Bitcoin. That's promo code Loonie Hour. Thank you, ShakePay. Now back to the show. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 67. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management in his, it looks like a new Patagucci jacket, and Rich Diaz of Acorn Macro Consulting. Welcome back to the show, gentlemen. Keith, is that a new shirt?
No, it's not. It's the, as my family would say, it's my only shirt, but I like to put it in the rotation for the podcast. So maybe I haven't worn it for maybe 2 episodes or something.
So fun story. I was messaging you guys in the group chat, but a good old hockey buddy of mine who I played junior hockey with in Ontario when I was 20 years old, Anthony Taylor, shout out. He messaged me. I haven't heard from the guy in a decade, and he goes, "Big fan of the show, man. Just got my first ever Patagucci. This is the comfiest sweater I've ever owned." Yeah, it's always amazing to sort of hear the people that are listening, and I still don't know why we don't have a sponsorship from Patagonia, but we're working on it.
I think that they've moved away from finance bros since it became a big thing to wear those puffy versions of those vests, right? And like on Wall Street, people wearing their white collared shirt and then they wear the puffy vest with the Patagonia. I think that they moved away from that. I think that they like poo-pooed all that. I'm not sure it changed any of the traders' minds.
I heard that as well. And apparently Davos at the World Economic Forum there, apparently everyone's wearing Patagucci. So
in Bermuda,
big fans of the show.
Yeah. In Bermuda, we always wore the vests, right? Because it got cool there in the wintertime. So you just needed a little extra layer on, just to keep you a bit warm. Anyways, right. That's it. This is football week, guys. My football projections are working out.
The Miners.
The Miners. So here's the prediction for Sunday. It'll be San Francisco 38, Cowboys 17. After the first quarter.
You could take take that to the money line, eh?
That's right.
Yeah, they're looking really strong. Those that know football, you have complementary football, your offense, your defense, and special teams. They all have to be working together at the same time. And it is for this team. So Mrs. IceCap, she's a huge football fan. I don't know if you guys know that, but she calls penalties.
Her into it, did you not?
No, but it works out great for the relationship. And but she calls penalties before the flags even come flying on the field, and not the obvious ones either. Like she knows all of them. So for this, like yesterday, today's Thursday, so it was Wednesday for us. She said, "Hey, let's go to the game this weekend." I said, "Seriously, yeah, price it for 4 tickets, 4 of us flying out, from here."
First class, box seats.
It's so expensive. This is the most expensive non-Super Bowl game in history on the weekend.
How much were the tickets?
To get in the door right now, you're probably looking at $800 US.
Jesus.
Yeah.
Man, and that's in the nosebleeds, right?
Rates. Yeah, they're pretty steep up there high at Levi Stadium. But anyway, we're not going to go. We'll wait for the Super Bowl, of course. Anyone else is going on? Rich, what's new?
More dates?
Rich,
I
come
I
on.
may
What do
or
you
may
got?
not have gone on a date. Monday, it was nice. Went out for Italian food. I was in bed alone by 9 o'clock. It was just getting my
Doesn't
feet
sound
wet
like a
out there,
good date
boys.
to me.
It was nice when we had a conversation.
What'd
I
you
didn't
talk
embarrass
about? What-
myself.
You're turning into a sophisticated man.
I've always been a sophisticated man. I didn't drink, which was great. Monday is one of my AFDs, so I got to behave myself on a Monday. But it was good. It was.
Oh, did you go on a first date and not drink?
It may or may not have been a second date. Anyways, let's talk about something else, please.
Well, let's talk about what people actually care about in this country. Canadian house prices.
That's right.
So we had the typical national housing data. Again, it always comes out January 15th, or sorry, the 15th of each month. So kind of a sort of continuation. The MLS home price index declined by another 1.6% month over month. Nationally, house prices on a year over year basis were down 7.5%. So that's actually the lowest. That's the steepest year over year decline since the index was created in 2005. So I think even in like the depths of 2008, I think like your largest annual year over year drawdown was about 6.5. So the pains, the beatings continue. If you look at where I think it gets really interesting is if you look at the peak to trough decline from last year. So officially that home price index peaked in March of 2022. And it's down 17% since it peaked, which is by far the steepest correction. I think the last time the largest correction was about 9%. So this has been, it's a huge drawdown. Now the most of the Ontario has a huge weighting in the index. So obviously, the more that sort of Toronto or the GTA declines, obviously that will bring down your national house price index. But if you look at it, you kind of break it up by, different major metros here. So, you had Canada down 7.5% on a year over year basis. Toronto was down 8.9, Montreal 0.7, Vancouver negative 3.3, Ottawa negative 4.6, Edmonton negative 0.8, and the lone sole outlier, Calgary, up 8.1%. So quite interesting. That's really like a market that still is kind of outperforming, or I guess performing less poorly. But
I have a dumb question. Why would Edmonton not be sort of exactly the same as Calgary?
I honestly don't really have a strong answer for you. I think that I think you're seeing more inflows of like people and investment dollars into Calgary. I think forgive me if we have some Edmonton listeners, but it's kind of the crappier version of Calgary. I'm sorry, but at least you guys got McDavid.
They're going to waste him. They're going to waste McDavid. That's a whole podcast unto itself.
Yeah, that is a whole podcast, but I definitely agree with you. So yeah, that's where it says, and it's interesting because I'm just reading the RBC's economics team. They've titled it "Canada's housing market inches closer to a cyclical bottom."
They've been listening. They've been listening to you, Steve.
They call the bottom. There you go.
Another bottom caller. So yeah, we'll see. I think like the biggest thing that we're seeing boots on the ground. It's funny. I was putting it out on Twitter and, just getting all the messages and replies is what we're seeing right now is like every kind of year, in December, into January, into February, like nobody really lists. It's kind of like your slow season. So there's not a lot of listings that come to market. So you always end up with like these very like inventory always kind of rolls over. And so what we've seen to start the year, and you're seeing this across all these major metros right now, even you're actually seeing it in the US. People, if you go follow any of the US accounts, they're reporting a lot of the same activity, which is inventory is really low. You have all these people that have kind of been delaying purchases. People that still want to enter the housing market, they're like, you know what? Prices are still high. Rates are way up. affordability stinks. I want to wait till prices come down. So that's what a lot of people have been doing. And they've been waiting, and they're seeing, well, the inventory is not getting any better. It's actually getting worse. And so I think there's definitely an element of people that I think are panicking and saying, and so they're now going and scooping up a lot of these like stale listings, stuff that's been on the market for 3 months. If you call these, listing agents, all of a sudden they're all under contract. So I think it's a bit of a panic where I would kind of fade the rally, because I think it's more of an inventory rally than it is like a demand fueled boom. So that's kind of how I'm looking at the markets right now. Still think there's more downside coming, but very, very challenging. We need to see a huge bump in inventory. Total inventory levels are very, very low.
Sorry. Do you mean, and is it semi-detached versus like apartments, or single detached, or is it like when you talk about this, you're sort of lumping them all in the same category just because I guess
I'm lumping them all in the same category. There's always going to be like, different performers within those segments, certain municipalities that have lower inventory of condos, et cetera, and stuff like that. But as the whole, we're lumping it's the thing, you lump the country and say, well, we're down 17% peak to trough nationally. It's like I said, most of those declines are predominantly in the GTA. And then you go to like a market like Calgary where you're like, well, prices are actually up. So it's like, we don't necessarily have a national housing index. I find it interesting because obviously, people like the Bank of Canada, our banking regulators are obviously going to be looking at the national statistics and saying, okay, what's happening? The other thing to note is housing sales activity. Home sales were down 39% year over year. So again,
that's volume of transactions.
So, yeah, very low transactions. Demand remains weak.
So can I ask one more question? Sorry, before we move on. We talk a lot about sort of the rate reset and how basically households are going to have to stomach much, much higher rates. Do you think that that's less of an issue than we might have argued or talked about 6 months ago? Do you think did we make too much of it? Do you know what I mean?
I think that there's a strong argument to be made that people that have been waiting for or calling the big Canadian housing crash since really 2006-07. I think there's a strong argument to be made that when rates go up, 400 basis points in a span of 12 months, that this is finally going to be the thing that kicks it over. And we're certainly seeing that from, again, these home price indexes, the largest drawdowns we've seen in 20 years. Right. So it's kind of playing out to some extent, but I definitely think a lot of this is the trajectory of rates, right? I mean, Keith, I'm curious your thoughts, but
isn't the like any market, of course, I would strip out the highs that we reached in, was it 21? I'm assuming
22. Feb 22
22
was like the peak in basically every market.
Yeah, so I always dislike measuring anything from a peak or the extreme peak or extreme trough. You sort of have to, Rich, the word normalize, of course. You want to normalize it somewhat.
It's one of my pickup lines.
That could be effective. I can see that. Anyway, I'm still not over this yet that, it's down from this level because we're measuring it from the peak. And I also suspect that if the country does experience a recession of any kind, I think that's going to, make that market a bit softer. Oh, by the way, I know last week we asked listeners to send us some anecdotal stories of, that's what anecdotal is, right? So anecdotes of, what they see happening economically. And we received a bunch, we received a whole bunch of them, whether it was on the YouTube comments or some emails and stuff. And you start piecing them all together, like the slowdown has started, but I don't think it's yet to start showing up really on a national basis. Is that what you guys saw as well for some of the comments we were receiving?
Yeah, I think so. I think that, I think it's definitely playing out, right? I mean, housing is always like your leading indicator, you're most sensitive to shift in rates. And obviously we've seen housing activity, it has collapsed. I mean, it's not strong. And, prices have followed that. So I think it is a matter of time until it filters through to the rest of the economy, which I don't think we've seen. Now, Keith, Rich, my always thing is So I'm kind of curious, like how this recession is going to play out. It's certainly the most telegraphed recession. But so on one hand, you've got the falling rates right now because, the economy's clearly slowing. People are optimistic on inflation and stuff like that. So your rates are coming back down right now, which we can get into. Now we know that we're going to have this recession and job loss and stuff like that. The question is, like, how much job loss are we going to see, and what kind of job loss is it going to be? Because, like, I think we've argued on the show before that there is certainly a structural shortage of labor in this current environment. And there's been some great reports out there where a lot of them, you can see the disabilities that have increased since the pandemic, whether, however they define those, but you've seen a lot of people that have exited the labor force through retirement or through illness. So I'm curious, like, structurally, I know like that companies are obviously reluctant to let people go. And so it's just one of those times where you get the recession, you get the drawdown in GDP, but you don't get as much job loss as you normally would.
It's pretty awkward, isn't it? Because you're hearing about, maybe we'll have the only recession on record where you're still seeing the help wanted signs all over the place. Yeah. It's a bit odd. And also I suggest, because the Canadian monthly employment data is so wacky, if we're picking up 100,000 new jobs a month during a slowdown, if we get a recession, maybe we'll see like minus 1 million or something. Well, my point is that I think the Canadian job numbers, I do not put a lot of weight on them. But here's the other observation with the recession. And again, this is my view with it. And if you go back over the last 40 years, so how old are you, Steve?
Not 40.
Not 40? Rich. So even back before that stuff, this is the first recession that, if it happens, and again, it's coming, that's purposely being orchestrated by all central banks at the same time, right? Every other recession has been driven by like a specific industry, something broke, or a region, or something like that, like the demand shock happened for some reason. So I think how this recession comes out, remember, that's the World Economic Forum, and but the central banks, they desperately want a recession to come on here, and because they want it, they will likely get it. And because they all want it at the same time, I think it's going to look and feel very different than what anyone has experienced before. And, again, I think it's going to create a lot of displacements and some very odd moments in terms of, like, especially with the employment side. But what do you think, Rich?
Well, I think there's a couple of things. Number one, I don't think you can have a recession without some kind of labor market contraction. I think it's like almost by definition. I'm not sure. I'm sure some politician has rewritten that definition in the last couple of years, but more or less, I think it just makes sense from an intuitive standpoint. And I think so that's the first thing I would say. So, and the second thing I'd say on the labor front, we've talked about this before, but maybe it's worth going over. You have an incredible inflection point in the demographics that we haven't seen in a long time, right? We talked about the age dependency ratio, which is how many working age people are relative to young and old. And, it peaked in 1960s, 1970s, depending on which country or region you are in. And it bottomed in 2010, 15, whatever, again, depending on which region. And now it's starting to climb. And it's climbing at a precipitous rate because there just haven't been enough babies, and there was baby boom, and there was just not enough, et cetera. Those demographic shifts. And so what we're seeing is a lot of people are retiring, moving away from the labor force in the US, just because I know the numbers off the top of my head. COVID or whatever has basically moved 5 million people out of the labor force in the last 2 years. Partly that's because they're cashed up boomers, partly because there's people who don't have childcare, partly it's retirement. And then in Canada, I think you have sort of a similar situation. And so, you might get that rare case where, because of demographics, because of the skills shortages that we've talked about, and I'm looking at it right now, the Canadian business survey, which is the Federation of Independent Businesses. I mean, the 44% of the small businesses that they survey still have shortages of labor. This is skilled and unskilled labor. Now, don't come at me with the unskilled bit. I get that there's loads of different types of skills, but this is sort of the economic definition, so you got to live with it. My point is that there's still a sort of a lack of warm bodies in jobs. So you have this like fight between a structural shortage of people who are able to to basically be placed in work. And then you have the inevitability sort of a contraction in the labor market, which comes from a proper recession. Maybe this will just be one of those situations where you have a less job loss, but to say that there won't be any job losses, I just think would be very, very difficult. That's a tough hurdle for me to sort of overcome intellectually.
I mean,
Go ahead. Is an economist a skilled or an unskilled?
Unskilled
worker. Unskilled. Okay. What do you have, Steve?
No, I mean, I think I tend to agree with Rich. I mean, I know that the narrative. I'm personally struggling with what the outcome's going to be. I know the narrative, it seems to be growing, at least in markets these days, around the soft landing, and maybe it's possible. Maybe we do get that soft landing. It's not going to be the doom and gloom hard landing that we get. I'm not saying I agree with that. I'm just saying that it seems, at least from financial markets, that's the narrative that is now taking hold in markets. Keith, I don't know if you have any opinion on that, but
yeah, it's kind of interesting because this week I saw a clip. So this is from Deloitte. Deloitte, their article says Canada facing deeper recession as interest rates take hold. Bank of Canada's interest rate hikes are going to slow economic growth, right? So you again, the verbiage is getting out there. And if we're going to have a recession, a deep recession, there's job losses, guys. It's going to happen. Like, we're not going to get this weird situation where it's just a bit sluggish or something. We've gone from two extremes. So we've gone from an extreme where like capital just stopped moving in the world, and then everyone received. Oh, by the way, did you see the Bill Morneau interview this week?
I didn't see the interview. I saw that he wrote a book that we should probably all read.
His interview about the book is quite interesting. People should. It explains basically why he split up with the Liberals and Trudeau and left. A lot of it was focused on the amount of stimulus that was going to be paid out during the pandemic. But it sort of goes over to this point that as soon as you swing from this period where there's so much liquidity in the system, so the central banks are gushing it out, commercial banks are lending it to everybody, people are still working and making money, companies are still making money, people are getting paid if they weren't getting paid before, from governments. When you go from that to really towards the opposite again, because we're getting these big swings with the pendulum, it's going to create something. So just this morning, for example, Procter & Gamble, they basically missed on the revenue side. So that's starting to happen. Whether it's interesting or not, Microsoft had a big layoff announcement as well. That's out there. So you're starting to see it. And the best way to think about how does a recession happen? It happens when I like to look at aggregate income. So instead of like, people are making this much money on average, if you look at all the income that's being produced in Canada, it doesn't matter if it's taking twice as many people to work to produce it or half as many people. It's the amount of income that's being produced in the country, and then how many times that is, you have the multiplier attached to it. As soon as that number starts to decline, economic growth will slow as well. And the great thing about economies where you do have a big participation by the private sector, because private sector, we love to make money and we don't like to lose money. So as soon as a company anticipates they may not make as much money or they're going to lose money, what do? Rich, Steve?
I don't know.
Start
I'm
cutting.
an economist.
Hey, you cut back, right? You
cut back
margins. Yeah, absolutely.
That's right.
So as soon as we start to see that happening, because the big thing right now, I don't think margins. This is for the U.S. market, for the S&P. I don't think operating margins can get much higher. I think Rich,
they're already falling. They're already starting to rolling over. They're already rolling over.
Yeah, it's just this thing, right? They can't get any better than what they are now. So if margins are coming off, then by default you need the top line to continue growing. I know you had that China story there was moving around over the last week. Maybe China was going to save the day, and all of a sudden now, like, it seems to be risk off again. Markets are rolling over and stuff. So with us, this continues on the path that we're expecting, and the path that we expect at IceCap is that we're going to hit a recession. It's either going to be a weak recession or a deep recession. That's it, like somewhere in between. Like, I don't think we're going to be able to avoid it. And then we're going to get fallout from that, and equities will lead it into that. And then we'll get, a really cool opportunity coming up. And I think that might come soon, to start adding risk on again, to the portfolios. This sort of ties a bit into the US data that came out this rich.
Well, can I just add one more thing? Rich? Can I just add one more thing just to put a bow on this? I think I was just like, now that you've sort of made me think about this, Steve, because we don't really rehearse this before we do the podcast, but it's like, maybe there's a third alternative, which might be the boring answer. But given my view on the US household, which is to say that it's unlevered and is basically as cashed up as it's been since 1965, I write about this on my Substack plug. It might just take a lot longer for it to happen than I think what people sort of anticipate. And so I think in my world, strategists are often early to these phenomena because, we got to come up with something to think about and talk about. And maybe because, there is sort of still, I would argue, ample liquidity, credit growth's okay, the banks are strong, we got decent savings in the household sector, certainly in aggregate. They're not being, in the US, they're certainly not being squeezed by higher mortgage rates, and households are unlevered. All of this phenomena that we sort of agree on in broad strokes might just take significantly longer for it to manifest. And maybe that's, I don't know, maybe that's sort of, as we think about it and we discuss it, I think that's sort of maybe a boring answer, but I think that might end up being the right one. Sorry, maybe move on, but
maybe that comes down to your Fed, higher for longer, right?
Yeah.
Because I think, the argument is that they need to crack the labor market. They need to get unemployment higher.
I would just suggest, like, the savings rate, there's a savings rate chart that people keep throwing around, which is how the savings rate is at an all-time low at 2.4%. That is technically true, but that absolutely misses the point. That is a flow, and not a stock. And what matters, I think, to most people is the stock of savings. At a given point in time, how much ammunition do you have in the bank, in your assets and whatever? And if you look at the currency, and so basically your deposits, so your current account balance, which is what they call it in the UK, or your checking account balance, what they call it in Canada and United States, plus your currency relative to your sort of short-term unsecured liabilities, that ratio is the highest it's been since 1965. And if you do that same number, again, this is like what you can draw away from the bank on a moment's notice without any, warning. There's not. So to me, that means that you have a household that's as cashed up as it's been since 1965, with nominal wage growth the highest it's been in 20 years, and then your debt with no debt. So it's not that. So that's why this higher for longer thing. I just, you add those pieces together. U.S. consumers 70%, 75% of U.S. GDP, and if they're okay, not great, but if they're okay, I think it's going to take a lot longer than we think for that recession to come through.
But that's quite the opposite of your Canadian household, right? There was no
very much so.
Yeah, there was no deleveraging in the GFC, and we've continued to accumulate a lot of debt, and wage growth is not as high, and you're very, very prone to the volatility in interest rates, right? The fact that you can only lock in a mortgage for the longest duration of 5 years means you're always susceptible to a rise in interest rates. The biggest thing that we're hearing anecdotally through mortgage contacts, investment advisors, and things of that nature is that households there's a lot of households that are struggling with the change in their mortgage payment. And one of the ways they're basically getting by right now is actually draining the savings, draining the investment account. So going to their advisor and saying, hey, I need to tap into my, my retirement account there. I need $100,000 or whatever I need. And because I gotta pay down my mortgage. I need to pay my bills.
And remember, wage growth in Canada is not anywhere near as high as it's been in the US. Sorry, Keith, please.
Yeah, I agree with Steve. And Again, I think we're a lot closer to that moment
Fair
where
enough.
things, start rolling over to become a bit more negative. Why don't we? But again, like this, again, it's very odd in that the setup is very clear that we are set up to experience deteriorating economic conditions, or for everyone else out there, less bonus, no bonus, job losses and stuff like that. Because a lot of people out there, man, they're working really hard. Some people work 2 different jobs, and the price of stuff has gone up so much. Like it is a bit of a grind here. Yet our central banks continue to tell us, the beatings will continue, until morale improves. And now with morale in the U.S. this week, do I go over the U.S. number?
Yeah,
first,
let's quickly.
Rich, or
So
the
let's quickly
Canadian
touch on
number?
because I think it ties in here, and we'll kind of wrap it up. But I think let's chat on the U.S. retail sales, and then we'll shift gears into Canada's inflation data, which came out this week, as well as the Bank of Canada rate hike predictions for next week. We've got to get our Twinkie bets in. But yeah, Rich, I don't know if you want to quickly touch on U.S. retail sales.
Yeah, so the retail sales fell 1% or 1.1%. I think it's it's a relatively big decline. I mean, I don't have much more to say than what you can read out there. I would just remind everyone that personal consumption expenditure is made of 2 items: services and goods. And retail sales is more or less focused on the goods section. And the reason I bring up those 2 bits, is because 2/3 of retail sales, 2/3 of personal consumption is services, which continues to ratchet higher and higher. And 1/3 is the retail sales goods component. They don't quite overlap, but for the purposes of this conversation, let's just say, for argument's sake, that they're the same. And so we're seeing
I think now I know why you only get 1 date at a time.
That's so mean. Retail sales is flatlining. In real terms, it's been flat for almost 2 years. But remember, that's only 1/3 of the overall bucket. So although there's definitely some negative, it's a negative number. It's unambiguously negative. I would just remind everybody that 2/3 of spending is services, and that continues to get higher and higher. Keith, any other shots you'd like to take?
Just giving you some suggestions. That's all. I'm more of a yield guy. So let's look at the retail sales from, the numbers were negative. Okay. So overall they're suggesting, people they're buying less, but the numbers were less than what was expected, what the economists had out there in the survey. So it's a very dovish number. So when that comes out, the markets will automatically shift the thinking to, oh wow, inflation is going to come down because people are spending less money and stuff like that. So it's a dovish number. And then at the exact same time, we had a producer price index data that came out, and that was weaker as well. By the way, with retail sales number, the prior month was revised lower, and then the current data was even lower than that still, right? We're starting to see evidence that the economy is rolling over. But from the American perspective, retail sales were lower. PPI data, no matter which way you stripped it out, it's not increasing as much. So again, this is data to suggest that the Federal Reserve, they could be at the end where they may hike rates. However, we keep going back to saying that's not what they're telling us, but this is what the market is looking at. So it was a pretty dovish week in terms of the American data that came out.
Yeah, and yet the markets fell, which is really interesting, right? Because for a long time, bad news has been good news. And for the first time in a while, I can't exactly remember the last time, but first time in a while, bad news was bad news. That is to say, when we saw the bad news on the data front, regardless of your interpretation, Keith is right, it was bad news. We saw the market sort of sell off. Sorry, Steve, what were you saying?
No, I think that was exactly what I was kind of leading to. And then obviously, resulting of that is your drop in bond yields, right? So people obviously buying the long end there. which is kind of what we've been chatting about it for a while, as potentially, a good trade, depending on, of course, when you put it on. But so that's kind of coming to fruition.
Do we want to talk about Canadian inflation?
Yeah. I think that kind of jibes with the Canadian inflation data, because like I said, I think this is it's all coming together, like big picture, right? Which is, inflation down, bond yields down. How does that impact, things such as housing, which we've chatted about at the beginning of the show? So, take it away on the Canadian inflation data we had. Lower than
jump
expected
there,
as well.
we have the American that the Fed is out on February 1st.
That's right.
Right. So we got that set up coming. We have the Canadians are next week, correct? Bank of Canada,
25th. Yeah.
Yeah. So it's coming out. And obviously that they tend to be moving in the same direction, but next week we'll come back and address the Fed. But this is one of the last big data points that the Fed will have before they come out with, what they're going to do. Remember, everything in the investment world, economic world, everything tends to move in this logical process, until it doesn't matter anymore. But Rich and Steve, you both guys made one of the key points so far. So markets are soft this week. And for the first time, it's turning soft when we're getting dovish data. And that's key, right? So now markets are starting to economic data is really starting to catch up to where markets are and things like that. But we have we got to talk about what the new Twinkie is going to be. Because remember the research note we saw this week? The Twinkie is actually not good for you.
Oh, right. It's banned.
Was it one of the worst?
It's banned in many countries.
Yeah, it's like the number one worst thing. Like I think
I'm not afraid.
It's funny. When I lived in Bermuda, we had there are cockroaches on the island. They're everywhere, and so they had this one spray thing called Baygon. Have you guys heard of Baygon before?
No.
There's a reason you haven't, because it's illegal everywhere in the world except for the Caribbean islands. In this thing, you could knock down a cockroach from 12 feet away, just whoosh, and it shoots out across the room. But I think maybe the Twinkie might be getting closer to that level. So I'm a big fan of the lemon loaf, so we got to think about that for next week. How we
You're really
feel
pushing hard for the lemon loaf.
Oh, I love the lemon loaf. It's
the Starbucks lemon loaf. It sounds like a treat.
Yeah.
No,
I like cheese danishes too. They're pretty good.
That's more the reason to bet on the Twinkie, to get the call right. Because if you get it wrong, you're gonna die. You have enough of those.
That makes sense. Okay, Canadian inflation is it there? She was gone. What did you see, Rich?
Okay. Okay, let's do a little quick rundown.
Rich put together a good note on Substack. So again, plug Rich, brilliant
shameless
writer.
Plug. Thank you.
For older people, plug apparently means they're encouraging you to go see it. Is that right?
That's exactly right.
Okay.
Go right.
Check it out, guys. It's really good information, Rich has.
So headline inflation continues to roll over. I'm not going to bore everybody with the numbers. You can read about it. But I think that there's 3 points, Keith, that I'd like to make clear. Headline fell to 6.32. Core is stickier, as naturally that's just sort of the way it's designed. It excludes food and energy. I mean, there's different types of core, which we can get to, but in general, it excludes food and energy. It was basically flat. So it's peak, but it seems flat. The main drivers continue to be energy. So most people, I imagine, can feel this at the pump. Energy prices had their largest month-on-month decline since April 2020, I think, if I can remember what I wrote. And that's a significant. Energy is 7.4% of headline. So it's a significant sort of pull on that overall number. Obviously, it doesn't affect core because it's core X food and energy, but still. Something that I thought was interesting was health and personal care continue to fly. So again, I think it's about this goods versus services, because housing operations and furniture, I think, are starting to roll over significantly. Again, when you buy a house, then you buy the white goods, then you buy all the furniture that goes into it. Shelter, which is sort of my favorite, and Steve hates this one because he thinks it's lagging and dumb, and he's probably right, but it continues to have a significant contribution, although that's rolling over too. One of the things that I thought was fascinating is the inflation expectations. So the Bank of Canada has an outlook, another indicator that they probably ignore, which is something called the inflation expectations. And there's obviously different ways that you can calculate inflation expectations. We've talked about this before, but there's market-based ones based on bonds and swaps and other derivatives. And then there's survey-based inflation expectation ones. This is one that the Bank of Canada does. I think it's quarterly. In fact, I know it's quarterly. And it's, what you think, what consumers and businesses basically think inflation is going to be X amount of time out. So in this case, it's 2 years out, and it went even higher. So 84% of the people that were surveyed think that inflation is going to be above 3% 2 years out. So that's to me, that's a really significant number. Now, could the surveys be wrong? Sure, but it's about what people think about the current inflation situation that they have right now, and it continues to go higher, not lower, despite what we know is true, which is the peak in inflation headline numbers and core, and obviously a lot of sort of the slowdown we're seeing in the economy. And then the final thing, which is the PPI, you mentioned it. Well, we got the PPI number for Canada too last week or this week. And it does a great job tracking, predicting core inflation. So remember, Steve, when we were getting all this grief about how we thought inflation was going to peak over Q4, I think, and we got all this blowback saying it's never going to happen. Well, we were right, and it is rolling over. And I encourage you to go check out the charts. I think they're I try my best to sort of explain it in a simple way, and you can check them out. So there you go. That was my inflation wrap up.
That's another plug. Another plug.
That's three.
That's three thus far.
Yeah, but that's a great description, though. What's happening with the Canadian data? Now, the Bank of Canada, they have that data as well. So, Steve, are you going to set us up?
Yeah, well, no, I've got just a couple more comments on some of that inflation. Rich bugging me about housing shelter, but so it's interesting that the largest contributor to annual inflation in Canada right now is actually mortgage interest costs. So obviously, the more interest you're paying on your mortgage, that's showing up in the sort of shelter inflation component. So, that's number one. Number two is what you can see here is the on the shelter component again. So Canada uses, yes, they factor in rents as well. They survey. Basically what they do is they survey rents from property managers basically that are running more or less commercial apartment buildings. So they're not surveying, your mom and pop landlord that's renting out the basement suite. Those people don't get captured in the rent. So that's one thing to keep in note. The other thing is that they track a huge component of shelter is CPI. It's homeowners replacement cost. So it's basically, what does it cost to replace the structure? What does it cost to basically rebuild somebody's home that you're currently living in? And so that index is actually rolling over. It's peaked. It's decelerating. It's obviously it's not declining in negative terms, but it is decelerating, which is kind of in line with what we're seeing in the real estate community, in the development space, which is that building costs, they haven't really come down. Like they're not, but they've stabilized. So they went up a lot, and then they basically stabilized. So, I think we're going to continue to see that in the months ahead. And then last quick thing here, Keith, I'm curious your opinion. Our buddy Ritesh Jain there had a good tweet, because I think there's always it's interesting. Like you can always find, you can always maybe use your confirmation bias to find data points to sort of filter through to fit your narrative or your worldview. And so I think there's a lot of people that I see on the inflation side that are like, oh yeah, we're getting hyperinflation. You look at this data point, it's, the decline in inflation was only due to gas prices, and those are surely going to go right back up. But
Say Shirley.
Yeah, sure. She's back. But he says Canada's headed for deflation. Yes, you heard it right. He says Canada's CPI is down 0.6% month over month, but the 3 and 6 month annualized rate at 0.79 and 0.19% respectively. So he says that was down from 12.6% in the first half of the year. Rich, I don't know if you have any comments on that. I think I put it in the group chat.
I do have comments. I think that's extremely difficult to have deflation, which is, again, only occurred really in a global financial crisis. when you have population growth of 2%. I just like just fundamentally those two things are, opposing forces. You literally just have more bodies coming onto our shore, not to make it like that visceral, but literally more people showing up who are chasing after a finite number of goods at that rate. I just find it to have deflation, that is to have inflation rate of change start to go below zero and stay there. I just philosophically and fundamentally, just those two things just can't square in my brain. And then the second thing I would say is you can hate the shelter component all you want, but it's going to stay higher. It's going to stay positive for a while, and it's 40% of the basket. So
yeah, no, I agree. I think the one thing I'd say, just to sort of back up Ritesh here, his view is more deflation over a very short period of time, maybe the summer kind of thing. But he's
okay,
still,
fair enough.
His personal view, just reading some of his replies and stuff like that is, and I actually kind of tend to agree with him, is that there's a high probability of this second wave of inflation maybe in 2024, right? If you get this deflation, quote unquote, scare for several months, it propels central bankers to maybe ease off the gas pedal and maybe ease potentially too early. And then we're back to more inflation in 2024 as governments, which they like to do, is spend money.
He's a smart guy, and I saw what he wrote, and so I'm not going to just totally dismiss him. And I think your point about the short term versus that longer term, I think is a fair one. To me, that the population growth number is very, very difficult to overcome, and that would be where I sort of rest my case.
Keith?
I think, I know Ritesh well. He's a super nice guy, freaking smart too. And I wouldn't get too caught up with the level. I think what's more important is the direction. And the point that Ritesh is making is that inflation data, it can start rolling over aggressively. And I know there are a few other guys out there, that are suggesting the same move and trend as well. And I think that's going to make it difficult for the central banks to continue with what they want to do. And remember what they want to do? Do you guys know?
Higher for longer.
They want to crush us like an ant. Remember Montgomery Burns on The Simpsons?
Yeah.
I'm gonna crush them,
like his paper cup.
Yeah, and he couldn't do it, right?
That's hilarious.
Anyway, the old man, yelling at the clouds.
That's you.
I have my number. I have my number ready.
Okay, so we got the Twinkie bet
Set it
here.
up.
This is to see who stays alive. Full disclaimer, don't eat these.
Whoa. Am I eating a lemon loaf or a Twinkie? Because my answer depends on what I have to eat. Oh, okay. Well,
yeah, the lemon loaf.
No,
that affects my answer.
Let's move on. They're not going to give us any sponsor. Let's move on. Let's.
If it's a lemon loaf, I want to miss. I don't want to be right.
Yeah, if you're eating lemon loaves, I'm showing up next time with like a cinnamon bun.
Okay, so who got the last? I think, were we all right last time or all wrong? I don't remember. Rich was right, and Steve,
No,
you
I
and I
was
were
right.
wrong.
I was right in Toronto. Remember?
Yes, the market.
I went with the market.
Rich went with the market.
Okay.
Our audience called 50, so Rich went with that, and it was 50. And so Keith, you actually people were giving you the gears because you had a 0 rate hike. So what do you got for us?
I was so I'll go first. So right now we're at 4.25, correct?
Yep.
I have us down at 25 next week, so we'll be at 4.5.
Rich,
That's it. I got nothing else to say.
I'm gonna go 50 again.
50 again.
I gotta make it interesting. I'm gonna go 50. I'm gonna risk my liver or my the sugar intake, or
Shock the world,
dye? I
baby.
think it's actually the dye that's really bad in those things. But anyway, yeah, I'm gonna go 50. They're gonna raise 50. I think they got freaked out by the inflation expectations.
I
number
thought
that
it was a
refused to
natural
come down.
color. That the yellows is it? What?
It's 100% beef.
Baked fresh every day. I'm gonna go. I'm gonna be boring. I'm sorry. I got to stick with Keith. I'm going 25. It's what the market's expecting. Yeah.
So by the way, it's not this meeting that's going to be the interesting one. It'll be the one after.
I think
that's
though-
what's-
Is it March 8th? I think.
Yeah,
it is.
maybe.
Yeah, March 8th. Yeah, absolutely. So that's the one. I think then we get back to, okay, and now what are they going to do? Anyway, so right now we're at 4.25. Most of us are saying 4.5. and we'll see where we are with
I think what's going to
right?
be important though, like if anyone decides to sort of, watch from home or tune into the press conference, I'm assuming he's giving one, is the language, right? I mean, the language at the last meeting when he went 50 was, he more or less in plain English, he essentially said, we're going to be basing future decisions on whatever the data says. And so, that's kind of a change in tone. So I'd be curious to see what he kind of comes out and says after this decision. I mean, certainly if you look at the data from today compared to his last meeting, it certainly has rolled over. I think it certainly gives him,
but
I think
you could, he had his fingers crossed though, and in his pockets when he was saying that. Guys, they want to keep raising rates. Right now, they're hanging out somewhere and they're listening to this and they're just laughing. They're saying we're going to keep raising them. And remember, it's not for us to agree or disagree with what they're doing. So we have to listen to what they're doing. And again, the Bank of Canada is the most difficult one to try to figure out. I think they're not consistent. If you are listening, like, please be consistent. That's all we ask of you. Whereas the Americans, the Americans are consistent. Even the Europeans.
I was reading an article from Scotiabank's chief economist the other day, and he was kind of,
it was Derek, right?
He was scolding Tiff Macklin with the BOC, basically saying this guy is so unpredictable. And he's like, good grief, can't you just be like the Fed and just tell us what you're going to do? Because Tiff's kind of surprised us really at every corner, every turn. He's the 100 basis point move in July, and then it's just he's been all over the place.
Well, you know what I love about him though, like most of us peaked in high school. Rich is still going up on his slope.
Thank you.
But yeah, there you go. But Tiff still hasn't peaked yet, right? He's still holding on to this as long as he can. But again, guys, jokes aside, the central banks, they're trying to create the recession and it hasn't happened yet. And they keep looking at it. So I don't know how they're going to achieve lower inflation without triggering the recession. Because if not, we're going to get this sort of lull, this gully, and then things are going to start ripping higher again later on in the year. And so right back to where they were.
The ironic part here is that, I'm in the real estate industry, so everyone's always eternally optimistic. But the funny thing that I'm seeing today is like what you're seeing, right? We talked about at the beginning of the show. So you have these really low inventory levels, activity starting to pick up. We're seeing, the bond market's pushing, interest rates lower. So, you can get a 5-year fixed mortgage today. It's not 5.5 anymore. It's 4.8. So everyone's getting optimistic. This is the last Bank of Canada rate hike. And I'm like, you guys, it's kind of like a double-edged sword, which is that while that may be true, the more resilient that the housing market is, the more ability it gives the Bank of Canada to keep rates high or to even keep going. Because they'd be like, well, look, hey, houses are going back into multiple offers. Let's raise another 25 basis points and another 25. So yeah, you're kind of damned if you do, damned if you don't, really.
So behind the scenes as well now, we have Canadian banks. They have to raise their equity they have. So a couple of them will be issuing new equity and doing different things like that. So again, I keep going, everyone is preparing for this slowdown. And if it happens, it's going to hurt mortgage portfolios. We had some bond fund news this week, a real estate fund news.
Yep.
Which one was that, Steve? Why don't you share that with us?
Private investors, this is kind of the next leg, I suppose, of the credit cycle. But private investors have basically queued up. They've lined up to basically pull about $20 billion in withdrawal requests from several of the large private real estate funds in the U.S. So I don't have the list handy in front of me of which ones those are. But the overwhelming sort of thesis here is that people are looking for liquidity, and so they're now lining up to basically withdraw their liquidity from these private funds, real estate funds. We've talked about it before in Canada, these mortgage investment corps, Romspin was one of the first ones to gate funds, gate withdrawals, 6 months ago. So I think we're going to see a lot more funds obviously gating withdrawals as they struggle to sort of muster up the liquidity to pay out these withdrawal requests.
And I think as well, we saw one of the larger Brookfield funds They have a monthly NAV. So they price their fund monthly. They've now had 2 consecutive months with negative returns. So again, like we're seeing the data is now coming out. And enough of that. One more note to bring up. I know we got to run in a few minutes. Is that right?
Yeah, we'll get close to wrapping it up here. A couple minutes.
The Bank of Japan. Anyone stay up late to watch the Bank of Japan news?
Only you, buddy.
Only me. So you might remember, I think it was 3 weeks ago, the Bank of Japan, out of the blue, they let the range for the long-term bond yield go higher by 25 basis points. And it shocked the world. It was like, holy smokes, they're going to try to reprice their bond market. So they want to allow long-term rates to go higher, which means the price of the bonds go lower. It sent the yen going higher and the equity market going lower. So you got the trifecta, the equity market, the currency market, and the bond market. Usually if the bond market goes lower, the currency goes higher. So you get that offset taking place. And they suggested at the time that, they maybe the phase they've been in, which is what, Rich, 25 years almost? I think
since the housing bubble in 1990, I would say, no?
Yeah, that's when things broke. But I think it was in 2000 they went to 0 rates, and then a couple years after they started doing QE. So they're 20 plus years into it, and they made the suggestion that now maybe is the time to come out of it. And so there's that the whole Butterfield analogy. Butterfly. Whenever a butterfly, when they flap their wings,
there's a tsunami in Japan.
Yeah, something like that. Except this was going reverse because it would have a big consequence. There's a lot of Japanese capital is outside of Japan, and all of a sudden now they're getting a reason, to repatriate it, and which would be very negative for Europe, by the way, for European banks especially. And so this week they had their next BOJ meeting, and the thought was that they were going to do the same thing again. And so, the day before or the day of the meeting, Japanese markets were just flying in anticipation of this. And guess what they did?
What did they do?
Nothing. They kept it the same. But nothing is not nothing happened. Because it's a lot of people have the view, and this is our view as well, if they let their bond market go, then it's just going to be game over. Like they're in so much trouble if you do it, because the banks automatically have to mark losses, pension funds, insurance companies, and stuff like that. So within a 2-week period, they basically came to their own decision that, hey, we can't go with that. So some of the data points, though, from the Bank of Japan, I came across this week. And just think about each thing that I say here now. So the Bank of Japan, they own more than 50% of all Japan government bonds outstanding. They own half of it. It's in the market.
EOC is not far behind, sir.
Yeah, that's right. We got up to 42%, I think it was.
I think it's lower now, but it was up to there. Keep going.
And which is a pretty big number. And the amount of debt in Japan is enormous, by the way. It dwarfs. So Japan is the second biggest debtor in the world. The Americans are one. It's Japan and Italy, I think. The Bank of Japan, they own more stocks or equities than any other entity in the world. So normally BlackRock is their largest institutional owner of stuff because they have so many funds, right? The Bank of Japan, they own more equities than anybody. They are a top 10 shareholder in over 40% of Japanese companies.
So I always find that interesting, maybe for like some people that are listening to this show that, aren't following this as closely, but I always find it interesting that a central bank, the BOJ, can basically effectively print money and buy equity in a company.
Yeah.
It's hard to kind of wrap your head around. And so it's like, you're having a shareholders meeting and, the BOJ minister is sitting there at the table because he's one of the largest shareholders.
Department of Labor, what do you think? Well, we don't.
Some of these companies have an incredible amount of cash, though. So I think we make fun of the Bank of Japan. They deserve to be made fun of. A lot of these companies in Japan are extremely, extremely cashed up. So, and this has been one of the bullish arguments for a long, long time, is that the Japanese companies would return cash to shareholders. They would deploy that cash in a more effective and efficient way. They would buy accretive. They'd make accretive acquisitions, et cetera, et cetera. So, I mean, of all the crazy things that the Bank of Canada, the Bank of Japan might be doing, buying profitable companies might not be the craziest thing. I mean, we know that the Bank of Switzerland does it. I think the Bank of Switzerland owns something like, and I want to say almost 1%, or like some, I can't remember. Don't quote me that number, but a huge amount of the S&P 500 is owned by the Bank of Switzerland.
I thought they were like weren't they like one of the largest shareholders, like Apple stock?
Yeah, they were, I think, at one point.
Yeah,
So
but
they're
that's flowing from the Americans through their swap lines and everything.
I'm just,
I think, but two comments with the Bank of Japan. First of all, is why are they doing that? As you said, they're printing money to do it. You know, it's not a real economy, you know, we're looking at there. And they've been doing it now for so long. They're trying to, I really laugh all the time. And, you know, some smart people say, oh yeah, we can inflate our way out of the debt problem. Well, Japan's been trying to do it for over 25 years. And again, it hasn't been that successful. But not only buying bonds, they're buying equities as well. Like they've completely taken their private markets and, you know, turned them to just another department from the government, and it just destroys capital. I think Japan just goes kaboom in the middle of the night. The second point is, I think I owe the Europeans an apology.
oh my goodness.
Maybe they're not the economic fantasy land. Maybe it's the Japanese.
Oh, wow.
What do you think? It's just coming to me.
I think you're probably right. I mean, I don't know, man. They own they're like, just the counter argument, just for just the sake of conversation, they own an incredible amount of foreign assets. And I know that, and they generate an enormous amount of money in return. So again, we've talked about the current account balance, which is exports of goods and services. And then there's different types of income that you get, which is the secondary income, which is like remittances, and the primary income, which is literally cash paid out in the form of dividends from investments in a building, in a oil field, in Apple, and whatever. And they still get an incredible amount of inflows from their foreign holdings. So maybe that's where,
but yet they still can't let the bond market price. Now what the Canadians will be looking at with this, I mean, on the public, on the government side, and same with the Europeans, like they're watching the Japanese experience, and you just betcha there's a lot of components of this they're just drooling over. They're saying, wow, like that's maybe the next step. You know,
the bank
do.
Bank of Canada's gonna start. Go ahead.
God help
yeah,
us
remember
all.
back when the pandemic started, you know, the Federal Reserve, you know, the Americans, you know, they didn't do it. They did a little bit, but it was the stick they carried. They said, hey, we're going to buy high yield debt.
I remember that.
They just announced, they said, we you know, you guys think we can't do it, but we can. We can buy high yield debt. And it's just a threat of it all. That's when we talk about, you know, the financial world has shifted. And it's been a very long, slow turn. It's been taking place over a decade. And we're now starting to get through to the other side of it. And again, like this kind of a world, it will discontinue at some point. And as it does, all of a sudden, you know, each country, like I like to say now, you know, risk has been synchronized. You heard me say that before. But as soon as one of them runs into trouble, each country is going to, you know, sort of retract, come back to themselves, protect themselves, and like that. Because one interesting thing we follow all the time is volatility measures for different currencies. So everything relative to the dollar. And they've been coming down for a decade. And since 21, they've now started to go higher again. And that's my point, that the bond market, the sovereign debt market is in a lot of trouble, but I think the risks will get reflected on the currency side. So what do you?
We don't have enough time.
We
don't have enough time. I know we have to run, but we don't have enough time to one more thing in Japan, that they came cap in hand to our dear leader to ask him for natural gas, and he rebuffed them. So Japan is an energy deficit country because they closed all their nuclear power plants. for reasons that remain unknown. And that's obviously a joke because of Fukushima in 2011. But anyway, so they import, let's just say for argument's sake, nearly all their energy needs until they restart their nuclear power plants. And they were importing 10% of their energy needs, or 10% of natural gas, whatever, an enormous chunk of energy from Russia. They no longer do that, in solidarity with the good people of Ukraine. And so Kishida, a Japanese minister, I can't remember what government, he came to Canada a week ago and asked Justin Trudeau for natural gas. And this is just a couple of weeks or 3 weeks after Justin Trudeau said no to the Germans, suggesting that there's no business case for Canada to produce more natural gas. I'm convinced that he thinks Germany and Japan are still part of the Axis powers and is not aware that we are staunch allies with these two good nations. And so I just have to throw that one in, because I think it's a real shame that Canada's not sort of helping out their allies, both from an economic standpoint, from a political standpoint, as well as a mission light standpoint. So Germany's burning more coal than they were. Japan is starting to burn more coal, and by exchanging that for natural gas, you could sort of hit two birds with one stone. But I don't know, Steve.
Well, one more last thing. We have an early nominee, the 2023 Angriest Person Award, and I think it's going to be Al Gore over at the WEF. Oh, God. You have to check that out on the line. Okay, Steve, wrap it up.
Yeah, Google Al Gore at the World Economic Forum if you're looking for some good entertainment. And it's a good place to wrap it up. As always, we appreciate your support. You've got the Loonie Hour with the Twinkie bet there. So we'll have a recap next week going over exactly what's going on at the Bank of Canada. I'm sure everybody's going to be sitting on the edge of their seat for that meeting. So we'll be going over that. But like I said, we always appreciate the support. If you don't mind, if you enjoyed the show, go to Spotify or Apple Podcasts. Wherever you're listening to this interview, give us a 5-star review, leave a comment. Certainly boosts us up in the algorithm, and let's continue to build the Loonie Hour community here. So we'll see you next week.